Intel just watched $100 billion evaporate in 48 hours, and it wasn't a market crash. It was one quiet decision from Beijing. Overnight, the former chip giant turned into a vulnerable piece in the global tech chessboard. A single policy shift from China now threatens the foundation of America's chip supremacy. It all happened silently on April 12, 2025. China's Ministry of Industry and Information Technology released a modest policy update, but the effects were massive. The new rule blocked government departments and state-backed firms from buying chips from U.S. companies, specifically targeting Intel, AMD, and Micron, citing digital security and supply chain risks. As reported by the South China Morning Post, Chinese procurement systems were rewritten almost instantly. By the next day, major contracts linked to China Mobile, State Grid, and Huawei-aligned server manufacturers were abruptly canceled. Intel, which earned 27% of its 2024 revenue, about $22 billion from China, saw its stock plunge. Bloomberg Markets reported an 18.3% drop by April 14th. But this wasn't just panic about sales. It was a signal. Investors saw the writing on the wall. China may be preparing to completely phase out U.S. chips from its tech stack. And maybe this wasn't just about semiconductors. It could be about dismantling U.S. tech leadership itself. On the surface, China's move looked defensive, but on closer inspection, it was something sharper, a well-planned offensive. Emily Jin, a geopolitical analyst at CNS, called it slow destruction, not decoupling. Intel's deep reliance on China made it an easy target. In contrast, firms like NVIDIA earn just 19% of their revenue from China and have been scaling their global AI partnerships. Intel, however, is still heavily tied to PC and server chips, core sectors embedded in China's telecom and enterprise infrastructure. So when China pulled the plug, the hit wasn't just to Intel's bottom line. It rippled through America's critical tech ecosystem. Intel's crash also dragged down semiconductor ETFs like SOKX and SMH. The PHLX Semiconductor Index dropped 4.2% in a single day. The Wall Street Journal noted widespread losses, but none as deep as Intel's, thanks to its outdated dependence on Chinese buyers. And when you zoom out, it's clear. This wasn't just one bad week. Intel's fragility was years in the making. Back in 2011, Intel owned 80% of the global PC chip market. By late 2024, that had dropped to 57% per IDC. Years of delayed transitions, especially the 10 nanometer and 7 nanometer struggles, gave AMD a massive opportunity. Meanwhile, Apple and Amazon started designing their own custom chips. Financial cracks followed. In Q1 of 2023, Intel posted a $2.8 billion net loss. Then came mass layoffs. 2,200 workers were cut in late 2024. By the time Beijing made its move, Intel had lost not just market share, but pricing power, strategic leverage, and resilience. Doug O'Neill, a chip industry expert at Rand, said Intel is still clinging to a business model from a different era, built on global access that no longer exists. Beijing just locked that door. But what if this wasn't just about punishing U.S. chip makers? What if it's part of a longer-term plan? There's a timeline, one that changes everything. According to Reuters, China is aiming to eliminate U.S.-made chips from all public systems, telecom networks, and energy grids by the end of 2027. This move, then, isn't a counterpunch. It's the start of a countdown. China's initiative, known as Clean Silicon, demands that by Q1 of 2026, 80% of central government computing systems run exclusively on domestic chips. For companies like Intel, this isn't just about market loss. It's about being systematically replaced in the world's second-largest tech economy. Morgan Stanley estimates this single policy could wipe out $350 billion in U.S. chipmaker revenue by 2027. J.P. Morgan adds that while the near-term hit is steep, the long-term threat is worse. If China pulls this off, it sends a powerful message. The world can build a chip industry that doesn't rely on the United States. That's not a ban. That's a blueprint. A model others, Brazil, Indonesia, even parts of Europe, might copy. But to go fully independent, China needs one thing: advanced chip production. And that's where the biggest shock came. In September 2024, teardown experts at Tech Insights stunned the industry. Huawei's Mate 70 Pro smartphone featured a 5-nanometer Kirin chip, made entirely in China by SMIC. The chip wasn't made with cutting-edge EUV tools from ASML. Instead, SMIC used older DUV equipment with complex multi-patterning, a process once thought too inefficient for sub-7 nanometer chips. This flipped the Western assumption on its head. The belief had been that without ASML's EUV machines, China would stall at 14 nanometers. Meanwhile, Intel was still struggling with yield issues at its Ohio fab and hadn't begun mass production of its 18A chips. Huawei's chip wasn't just a lab test. It worked. It shipped. And in just 6 months, Huawei sold over 45 million Mate 70 units per Canalys. That showed not just domestic demand, but supply chain readiness. SMIC's revenue surged 47% year-over-year in Q1 of 2025, mostly from government-backed orders. Intel, on the other hand, saw its data center revenue fall 22% in the same quarter, according to its earnings report. The U.S. strategy was to slow China by cutting off its access to advanced tools, said John Bateman, a tech policy expert at Carnegie. But the game has changed. But China didn't chase the next big thing. It focused on scaling what it already had. And now, it's winning. With Huawei's chip ecosystem fully operational, replacing Intel in China is no longer a technical hurdle. It's just a countdown. Let's pause here, because this isn't how the story was supposed to go. The U.S. had the patents, the machines, the suppliers. Yet somehow, Huawei surged ahead using none of the so-called indispensable tools the U.S. insisted were critical. And if Huawei can do that with smartphones, what happens when they aim for servers, cloud computing, and AI chips? What started as a policy blueprint in 2015 has morphed into one of the most aggressive industrial revamps in modern history. By Q1 of 2025, over 75% of China's core sectors, like aerospace, power grids, and telecom, had begun transitioning to domestic chip makers, according to the China Center for Information Industry Development. Firms like Huawei, SMIC, and Lungsun are now pulling in more than $58 billion annually in state support. At the same time, U.S. giants like Intel are being quietly removed from Chinese procurement chains. Nina Xiang, founder of China Money Network, says this isn't about catching up to the U.S., it's about replacing it entirely. China is constructing a parallel ecosystem, one that doesn't need American technology. The numbers back it up. The U.S. share of China's chip imports fell from 41% in 2021 to just 28% in 2024. Meanwhile, local chip makers now control more than 55% of government computing contracts. So the real question isn't if China can ditch U.S. suppliers. It's when they'll be able to walk away for good. And the clock is ticking. Can Intel catch up before it's permanently shut out? Or has that window already closed? The CHIPS and Science Act unlocked $52.7 billion in federal support, and Intel is set to receive the biggest slice. As of March 2025, the U.S. Commerce Department confirmed Intel will get $8.5 billion in grants and another $11 billion in loans. But even with all that funding, Intel is still struggling to deliver. Its Ohio Silicon Heartland facility is now expected to begin partial operations in late 2026, almost a year behind schedule. The delays are blamed on zoning disputes and construction holdups. Meanwhile, Taiwan's TSMC is preparing to begin 3-nanometer chip production at its Arizona fab by Q3 of 2025, according to a Wall Street Journal report in March. Intel's $8.2 billion deal with Amazon Web Services, announced in February, might provide a temporary boost. But analysts at Bernstein say it won't make up for the estimated $13.7 billion in annual revenue Intel risks losing in China by 2027. Abhinav Davuluri at Morningstar summed it up. Government support may keep Intel afloat, but it can't fast-forward Moore's Law or reverse lost years. So what does this mean for regular Americans? It's not just about Wall Street. In 2025 alone, Intel confirmed layoffs for 1,250 employees in its data center and client computing units, mostly in Oregon and California. SEC filings show these cuts followed a 19% drop in Q1 client processor shipments, driven by weaker global demand and missed sales abroad. Next, it'll hit consumers. Internal pricing roadmaps leaked to Bloomberg Tech reveal major PC makers like HP and Dell plan to raise prices on upcoming Intel-powered models by 12 to 17%. Why? Supply uncertainty. With China no longer absorbing large chip volumes, Intel is forced to scale back production or raise prices. And it's not just laptops. Cloud servers, enterprise gear, and AI systems in logistics and healthcare are all set to get more expensive. This isn't a far-off supply chain problem. It's about to show up on your next invoice. Even with federal money and consumer price hikes, the question remains, can Intel recover? Or are we witnessing the early stages of a slow unraveling? Intel's fate now hinges on a race between capital and relevance. It has over $19 billion in public funding, a high-profile AWS deal, and support from the Department of Defense. But the market isn't buying it. Intel stock has underperformed the PHLX Semiconductor Index by 31% over the past year. Goldman Sachs recently downgraded the company, citing shrinking margins, constant delays, and rising global competition. Then there's innovation, or the lack of it. Intel's 18A process node isn't expected to launch at scale until mid-2026. Meanwhile, TSMC and Samsung are already mass-producing 3-nanometer chips and testing 2-nanometer prototypes. Former CEO Pat Gelsinger, now serving as a strategic advisor, told CNBC in March, "It's not about one good quarter. It's about surviving the next decade." But survival takes more than factories. It requires regaining technological dominance. And so far, Intel hasn't proven it's ready. And Intel isn't the only one in Beijing's sights. China's strategy stretches beyond one firm. It's reshaping the entire playing field for global tech. This isn't just a chip war anymore. It's a full-blown power shift. China's next move? A possible export ban on gallium, rare earths, and AI training chips, a direct shot at the U.S. supply chain. Washington is working on a response, but it may already be too late. Because the real question now isn't just about chips. It's this. Can the country that invented semiconductors survive without control over the supply chains that now build them?